Hey everybody, I'm Mikey Millions, and if you read the title correctly, you'll know that in this video, I'm going to show you my dividend portfolio, which during this bear market is what's keeping me sane and happy. But as I talk about dividends, I want you guys to keep in mind the very important Finfluencer indicator. The more finance YouTubers, Finstagrammers, and FinTalkers you see talking about low-risk things like life insurance and dividends, the closer we are to the market bottom. And the more of them you see talking about crypto and leverage and options, the closer we are to the market top. Obviously, in this video, I'm talking about dividends. Keep an eye out for other finance YouTubers doing the same thing, and that will tell you when the market bottom is in. And yes, I'm being entirely serious about that. Last year, I was mostly invested in growth, but I expected the market to top at some time in 2022 or 2023, and I planned to spend most of this year moving some of my positions from growth into dividend. Now, technically I was right. The market did top on January 3rd, 2022, and it's been all downhill since then. But that really isn't what I had in mind about the market topping sometime in the next 2 years. So I had to accelerate my pace of moving from growth into dividend. Now that I've adequately adjusted from growth into dividend, I'm spending the rest of my year investing new deposits back into growth instruments. With the market having dropped, this is still a good buying opportunity. Now, with no further ado, let's talk about dividends in my Merrill Edge accounts. My total portfolio on Merrill Edge is about $560,000. It used to be higher, but I am not immune to the bear market. Of that $560,000, about $250,000 is invested in blue chip dividend stocks like Coca-Cola and Prudential, or in dividend ETFs like JEPI and QQQX. Another $190,000 is invested in indexed ETFs like SPY and QQQ, which do pay a dividend even though they're primarily growth instruments. In this video, we're going to focus on that $250,000 that's invested specifically into dividend holdings. Together, they pay about $22,300 annually. That's a pretty high yield at about 8.9%, and when we're hunting yields, we have to make sure that we're not falling into yield traps. We'll talk about that and some other pitfalls at the end of this video. Enough of all that, let's get down to brass tacks. What's in my dividend portfolio, starting with my favorite? The first one I want to look at is QQQX. That's the Nuveen Dynamic Overwrite Fund. It is head and shoulders above the rest, my favorite dividend fund. I've got 3,497 shares, currently worth about $70,000. They're yielding about 9.5% based on today's price. Distributions are paid quarterly. It's really important to understand why this fund is unique and why it should be in your portfolio too. QQQX is a covered call fund. It makes its money by buying the NASDAQ index and then selling covered calls on between 45% and 75% of its holdings. The percentage that they choose depends on what the managers believe is the best amount to sell during that time. They typically sell covered calls on 55% of their holdings. During the quarter, the fund gathers that premium and then distributes it to us as shareholders at the end of the quarter. Since QQQX sells covered calls on about half of its position and keeps the other half naked, that means that it can benefit from both share appreciation and pay out high dividends. One of the fund's stated goals is also to maximize tax efficiency for its shareholders, so it will perform returns of capital instead of dividend distributions whenever it's possible. I have a video on that if you're interested in it. Basically, it means that you don't pay tax on some of the distributions. I'll spend a little bit of extra time on QQQX to explain a very important concept in dividend investing that I think a lot of people get wrong. So many dividend investors say they don't care about price appreciation because they're only interested in collecting dividends. That makes absolutely no sense, and it drives me crazy. If you're getting a 7% dividend yield, but your stock is dropping 8%, you just lost money, and you still have to pay tax on that 7% distribution. There are going to be some years where that just happens, like this bear market, and that's okay. But if your fund is perpetually losing money and paying out dividends that do not exceed the amount of money that the fund is losing, then it is not a winning position. If someone tells you that they're fine with that, they're just coping. Of course, dividend investors still care about price appreciation, or at the very least, avoiding perpetual price declines. What makes QQQX and a few others so special is that they allow themselves space to recover from dips. Keeping some of their holdings naked allows them to benefit from price appreciation during bull markets. This space does not exist for a lot of other funds like QILD, which sells at-the-money covered calls on 100% of its position. Your fund cannot recover from a price decline if it's selling at-the-money covered calls after the price has already declined. A warning to all dividend investors: make sure that your fund's model actually makes sense and that it allows itself space to at least not continuously decline in price, even if your coping mechanism is to tell yourself that you don't care about appreciation, you only care about dividend. you know you're lying to yourself. The only bad thing I can say about QQX is that it has a pretty high management fee of over 0.9%, and that's going to drag the price of the fund down versus QQQ. But if you were selling covered calls on your own, you'd be paying that in commission anyway. And to me, it's totally worth the 0.9% to have somebody else do all that wheeling for me, and to make sure that I'm getting returns of capital when possible, instead of paying tax every time I receive a distribution. I love QQX, which is why I spent so much time on it. I strongly recommend watching the videos on QQX versus QYLD versus QYLG, and I think you'll agree that QQX is the best of the three. My next favorite is JEPI, J-E-P-I. That's the JP Morgan Equity Premium ETF. I have 1,716 shares worth about $88,000. They're yielding about 10.25% based on today's price. That's elevated right now because volatility is high. Typically 8% is generally what you would expect from JEPI, which is still pretty high. JEPI is similar to QQX in a lot of ways. The ETF holds shares of blue chip dividend stocks traded on the S&P 500, and then it sells out of the money covered calls against those shares in order to generate more premium. Then the dividend and premium get distributed to shareholders monthly. Shareholders have to expect that the dividend is going to vary month to month depending on which stocks in their holdings are paying dividends and how much premium they're able to generate by selling out of the money covered calls. I really like this fund a lot because I really like its model. It's very similar to QQX, and also because it pays the dividend monthly. That's not as big of a deal as a lot of people make it out to be, but it is nice to receive that premium income when other companies are between their dividends. But most importantly, its model allows it to recover from any dip right alongside the S&P. The ETF selling out of the money covered calls gives it space to recover after bear markets. Again, unlike some of those other funds like the YLD funds. And since it's holding blue chip companies, it has a little bit lower beta than the S&P. And that means that it will lose less money than the index during bear markets. And that has held true this year, even before you account for the effects of the dividend. JEPI is fantastic for reducing your beta so that you'll have less sensitivity to volatility. And the monthly dividend can help you mentally, and it also allows you to reinvest faster than if you received quarterly dividends. So it helps out mathematically too, if you really want to crunch numbers. On the negative side, JEPI doesn't have any tax optimization policy like QQX. So you're going to pay tax on all of your dividends unless you're investing in this in a retirement account. For that reason alone, I still like QQX more. The reason I have more JEPI than I do QQX is because I already have a lot of exposure to the NASDAQ with my holdings in QQQ itself. If I were to go even deeper into QQX, then I would just be investing more into tech. By going a little bit farther with JEPI, I've diversified my income streams just a little bit. The next largest is Realty Income. The ticker is O. This is the largest non-ETF dividend position I own. I've got 546 shares on Merrill Edge worth about $32,000, and I've got another 100 shares on Webull. Right now, the stock is yielding 5.1%. Realty Income is a real estate investment trust. Basically, it's a landlord company for commercial properties. They own the land and the buildings, and they use a model called triple net lease. That means the tenant pays for the taxes, the insurance, the maintenance, everything. This wouldn't even be legal on residential real estate. But for commercial property landlords, this is a great moneymaker. To qualify as an REIT or a REIT, the company must pay 90% of its taxable income in the form of dividends to its shareholders, and Realty Income is very proud to do this. The company takes its dividend payouts so seriously that they trademarked the name the Monthly Dividend Company. It hasn't missed a dividend payment since its founding 53 years ago, and over the past 40 years, it has increased its dividend every quarter. Even during the real estate crisis of 2008, Realty Income still increased its dividend all the way through. Now, these are really small dividend increases. We're talking maybe half a cent per quarter, but the stock has also done a really good job keeping pace with the S&P. In fact, it's outperformed the S&P over the last 10 years. So you're getting capital appreciation in addition to that ever-increasing dividend. I like Realty Income a lot. I'll probably never sell it since it's always increasing its dividend and it's keeping up pace with the S&P anyway. If you don't have O in your portfolio, buy some O. My dividend positions start getting a lot smaller after the big three, but the next largest position is SPHD. This is the Invesco S&P 500 High Dividend, Low Volatility ETF. I have 414 shares worth about $16,600. Currently, it's yielding about 4.14% on its current price of about $40 and change. SPHD holds S&P 500 companies with high dividends and lower volatility than the rest of the index. Or at least that's its stated goal. And to some extent, it is successful. But if we compare it to its peers SCHD and SPYD, it's actually underperforming the others in capital appreciation. We're here for the dividends, and SPHD's 4.14% is yielding higher than SCHD's 3.7%, but SPHD is yielding less than SPYD's 4.5%. And SPYD is outperforming in terms of capital appreciation. So what am I really getting out of SPHD that I wouldn't get out of the others? I think I'm likely to move my SPHD into SCHD because I'm attracted to the higher share appreciation and I'm willing to give up a fraction of a percent of dividend in order to get it. The alternative would just be to take the money and throw it into realty income, because realty income has a great yield right now at over 5%, and it's almost certain to never drop in nominal terms. Or I could even throw it right back into JEPI. I'd even get a tax write-off for selling my SPHD because it's in the red. But of these three funds, SPHD, SCHD, and SPYD, one of these should be in your portfolio. These are well-diversified funds, and you get the advantage of having qualified dividends if you hold them long enough. So even though I'm getting out of SPHD, still consider jumping into one of these three. I can break down my litany of other dividend stocks, of which I hold less than $10,000 in each, but I'll start by saying that they're mostly pulled from the Dividend Aristocrats. Getting that treasured patent of nobility tells investors how reliable these companies' dividends are. To be a Dividend Aristocrat, the company must be traded on the S&P, have an over $3 billion market cap, and pay and raise dividends for 25 straight years. A company that gets that title will push to hold on to it, and one missed payment will strip them of their status. Occasionally that does happen, like when AT&T cut its dividend after 35 years when it spun off Discovery. And it also happened when furniture manufacturer Leggett & Platt got kicked off the S&P. But by and large, when you purchase Dividend Aristocrats, you are locking in the dividend rate at which you buy. The Aristocrats that I hold include Coca-Cola, that's KO, Altria, that's MO, and Prudential, PRU. Prudential isn't actually an aristocrat since it cut its dividend in 2013, but since then it's been committed to reclaiming that title. The largest position I have of these three is Altria, ticker is MO. I have 314 shares worth about $13,000, and I have a few more shares in Webull. Altria is mostly a cigarette manufacturer with a couple of other ventures. They also own a stake in a cannabis company called Cronos. Its share price got destroyed when the FDA banned Juul. Now it's yielding about 9.1% on its current share price of about $41. I think that huge price decline is ridiculous because Juul was one fraction of 1% of Altria's top line. My favorite author on Seeking Alpha is Dividend Sensei, and his DD indicates that the share price for Altria is way too low. I'm adding shares of MO whenever the price drops below 42. This one is a great pickup for its 9.1% yield and for long-term growth. The next one is Coca-Cola, ticker KO. I've got 105 shares worth about $6,000. Currently, it's paying a 3.11% yield, which is less than treasuries. But I bought when the share price was $46, so I'm getting 3.88%. Still pretty close to treasuries. We all know Coca-Cola, it's a very safe bet, but like I said, the yield is less than treasuries. So if you're just looking for dividend, then KO is not a good choice right now. However, although Coca-Cola might seem boring, it is great for people that want both that dividend yield and long-term share appreciation. Its growth is slow, but it is consistent. Nobody's gonna dunk on you for owning 10,000 shares of Coca-Cola. And the last aristocrat is Prudential. Like I said, Prudential is technically not an aristocrat since it cut its dividend in 2013, but I'm giving it that honorable status since it has since recommitted to its dividend. I have 109 shares of Prudential worth about $9,700. It's currently yielding 5.4% on its current share price of $89. But credit again to Dividend Sensei's DD. I bought shares in the summer of 2020 when the price was $65. So I'm getting 7.5% yield on my investment. Prudential is primarily a life insurance company. Its bottom line got dinged hard during the pandemic, especially because old people dying meant that the company was losing assets under management and it was paying out more life insurance policies than it normally would. But COVID-19 has been pretty tamed by now, and I think this bear market is going to bring a lot of people back into more conservative investment strategies like life insurance policies. Prudential is already getting out of its rut, and I think this is a really good buy. If it drops more, buy more. You can't go wrong with Dividend Aristocrats. You're buying a relatively high yield without giving up too much share appreciation. In fact, the Dividend Aristocrat ETF NOBL Noble is neck and neck with SPY. The last big dividend stock I own is Energy Transfer, ticker ET. I have 325 shares of ET worth about $3,600. Currently, it's yielding 8.1% on its share price of $11.30. I'm getting 11% yield on my buy price of $8.20. Energy Transfer is a master limited partnership, which means that if you have a low service broker like Robinhood, you'll have to do a little bit of additional work when you file your taxes. If you have a full service broker like Merrill Edge like I do, then you won't have to do any additional work. In fact, I don't even notice any difference on my taxes at all. My broker handles all that paperwork for me. Energy Transfer is an oil and gas company that controls pipelines across the US. Energy has been that one shining sector throughout this bear market, and the company is doing very well. It did some financial restructuring in 2020, which included slashing its dividend in half. But that restructuring put their balance sheet back in order, and ultimately it was a great move. Company leadership doesn't anticipate any more cuts in the near future. I wish I bought more shares back then, but I probably will start buying again in the near future. Energy might take a dive again in this recession, but Energy Transfer is one step away from the consumer because it doesn't sell oil and gas. It sells transportation services for those materials. If ET ever goes below $9 again, I'm loading up the boat. All in all, here's what my dividend income looks like on Merrill Edge. I get another $1,000 or so annually on Webull. The dividend varies month to month depending on which companies are paying, but on average, it works out to about $2,000 a month. These big months each quarter are the impact of QQX. Like I said, I've got about $250,000 invested in specifically dividend holdings and $190,000 in indexed ETFs. This is what that portfolio structure gets you. I generally reinvest my dividend income into growth companies. But if I see a dividend stock that I like trading at a lower valuation than is typical, for example, Altria, I will purchase more of those shares. Sometimes I'll withdraw my dividends and actually spend it. There's a novel idea. Don't overspend and get yourself in trouble. But you also don't want to hoard all of your money in dividend stocks and never spend anything, because then you'll die rich and unfulfilled, buried next to a big pile of moldy money. Although that's kind of a morbid thought, that's a common problem that I see among dividend investors. So let's talk about dividend investing pitfalls. The most common pitfall is the yield trap. Dividend investors see a company like ZIM, printing a 115% dividend and they get all excited. But paying a dividend like that is impossible. Even back when ZIM was trading for $75 and yielding 40%, that's still unrealistic. And I remember so many people talking about how ZIM is this great dividend investment because it's going to pay this high dividend month after month, quarter after quarter. I could tell immediately that that was a yield trap. When yields get that high, it's because the market doesn't believe that the company can pay it. Besides, you have to remember that a company's price will drop by the amount of the dividend on ex-dividend day, and then you still have to pay tax on the dividend you receive. You get no value buying into a stock that's paying 35% dividend when the share price drops 40%. You have to make sure that your company is profitable after it's paying its dividend in order for that share price to not precipitously fall. The next pitfall, it's more of a mental thing than anything else, is what I talked about before. Perpetually reinvesting your dividends into more dividend shares without ever spending any of your money. Dividend investors love looking at their distributions as another source of income to buy more shares of dividend stocks. You should do some of that when you can. It is important to make sure that you're reinvesting your dividends when it's possible. But I do caution that it is very tempting and very easy to continuously reinvest that dividend and try to make a growth instrument out of your income instrument. My recommendation is to find balance. Remember that you want dividend in order to take care of your needs. You don't just want it to try to manufacture a growth fund. If you wanted that, you could just invest in growth funds. And finally, right along those lines, don't neglect growth in exchange for just dividend investing. Growth portfolios generally outperform dividend. If you want your portfolio to get larger and you're not spending any of your dividend income, then you are probably better off moving some of your money into growth instruments instead of just being in dividend. I rarely reinvest my dividend into the same company that paid me. If you are constantly and perpetually reinvesting your dividend income, then you probably don't need the dividend income, and you would have been better off going with growth. But we're also not purely growth investors. We want some of that dividend for the flexibility. Do I want to spend it? Do I want to reinvest it? But to make sure that I'm not continuously underperforming, I take most of my dividend and reinvest it into growth instruments whenever I feel like I can. Guys, stay sharp during the bear market. Keep your eyes open for dividend investing opportunities. A lot of stocks are getting unfairly beaten down. Their yields are rising for no apparent reason. buy into those stocks and get that high dividend. And also keep in mind that there's going to be investment opportunities out there that we've never even thought about before. Treasuries are yielding almost 4%. If you're a dividend investor, you might consider adding treasuries to your portfolio. I-bonds, they're over 9% right now. Tax-free municipal bonds, they're higher yields, and they're tax-free. All of these things are something that we've never really had to consider before during the bull market. But now it's a whole new investing environment. Keep your eyes open for things that you want, especially if you're an income investor, because there will be opportunities. I recommend the Seeking Alpha author Dividend Sensei if this is the type of investing you want to do. See the link in the description for a 58% discount on your subscription. In short order, it'll all pay for itself. That's all for this one. Thanks for watching, and I look forward to seeing what you guys have to say in the comments section. I'll see you next time.